Good afternoon. I'd like to welcome you all here to the monthly meeting of the Pittsburgh Economic Club. I'm Gus Fauché. I'm a senior economist with PNC, and I'm also the president of the Economic Club of Pittsburgh. And thank you very much for coming today. I'd also like to thank our co-sponsors for today's lunch, the CFA Society Pittsburgh and the PSIP, the Pittsburgh Society of Investment Professionals, and we're very happy to have their co-sponsorship today. And if you'd like more information about these organizations, you can talk with their representatives who are here today. For those of you who don't know about the Economic Club of Pittsburgh, we are a group of economists and those interested in economics. We meet roughly every month here. We have guest speakers usually. Previous guest speakers have included Paul O'Neill, the former Treasury Secretary and retired CEO of Alcoa. We've had Mayor Bill Peduto speak. We've had Jamie Dixon, the head basketball coach for the Pitt men's team. And then we've also had Sandra Pianalto, who was the previous president of the Federal Reserve Bank of Cleveland. Our upcoming speakers include Marty McGuinn. He's the retired CEO and chairman of Mellon Financial Services, and he'll be speaking next month, October 15th, on Pittsburgh Promise. And then we also have our annual forecast lunch scheduled for January 15th, and that will feature Stuart Hoffman, the chief economist at PNC, and Dick Huey, the chief economist at BNY Mellon. So I would encourage you to go to our website, econclubpgh.org, if you have any further questions about the Economic Club of Pittsburgh and about our membership opportunities. I mentioned Sandra Pianalto, who was the previous president of the Federal Reserve Bank of Cleveland. We are very privileged today to have her successor, Loretta Mester, who is the president and CEO of the Federal Reserve Bank of Cleveland, here to speak with us. Previously, she was for a number of years with the Federal Reserve Bank of Philadelphia, and she ended her tenure there as executive vice president and director of research. She's published numerous papers and has spoken at numerous conferences on issues of central banking, financial institutions and financial institution regulation, credit markets and inflation. She has a PhD in economics from Princeton and a bachelor's from Barnard College in mathematics and economics. And she is currently, as I mentioned, the president and CEO of the Federal Reserve Bank of Cleveland, and that covers the Ohio, Western Pennsylvania, the northern panhandle of West Virginia, and eastern Kentucky. And from what I understand, this is actually her first speech she's given as president, and so we're very privileged to have her. And also one very important point, which is that she is a voting member of the Federal Open Market Committee this year, which sets monetary and the policy in the United States. So it's a great honor to have her. She's going to be speaking, and then we'll have time for questions afterwards. So once Dr. Mester has finished speaking, if you have a question, if you want to move to the microphone. But thank you very much, Dr. Mester, for coming, and welcome.
Thank you very much. So it's a real pleasure to be here today and to address the Economic Club of Pittsburgh, the CFA Society Pittsburgh, and the Pittsburgh Society of Investment Professionals. So I've been on quite a journey during my first 3 months on the job as the new president of the Cleveland Fed. Not only have I attended my first 2 Federal Open Market Committee meetings in Washington as a voting member, but I've been getting to know the 4th Federal Reserve District, which includes Ohio, Western Pennsylvania, the northern panhandle of West Virginia, and eastern Kentucky. One of my first stops was to Pittsburgh, and it is wonderful to be back here today for my first public speech since becoming president in June. Now, the economy and monetary policy have been on journeys of their own. Today, I want to share my views on both. But before I continue, let me note that these are my own views and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. The economy is now in its 6th year of expansion. It's been a slow and difficult journey with some stops and starts along the way. And while the final destination has not yet been reached, the economy has made significant progress on the road back toward fulfilling the Federal Reserve's goals of price stability and maximum employment. Perhaps the clearest signals of that progress are in the labor market. Tomorrow, all eyes, including my own, will be on the Labor Department's monthly jobs report for August. Because these statistics can vary from month to month, rather than focus on one monthly number, I like to look at the underlying trend in the data. Here, the news is good. We've seen steady improvement in labor market conditions. So far this year, non-farm payrolls have risen an average of about 230,000 jobs per month, which is somewhat stronger than last year's pace and represents significant progress since the start of the recovery. In addition, there's been some consistency in those gains, with monthly increases of more than 200,000 jobs in each of the past 6 months. While the recovery in jobs has been much slower than anyone would have liked, as of this May, the economy finally met the milestone of having added more jobs during the expansion than the 8.7 million jobs lost during the Great Recession. The unemployment rate is another important gauge of labor market conditions, and it too has shown substantial improvement. It currently stands at 6.2%, down from a peak of 10% in October 2009 and more than a percentage point lower than a year ago. Of course, unemployment rates vary by region depending on a number of factors. The Pittsburgh metropolitan area's unemployment rate was near the nation's before the recession, but it did not rise as high and has been running somewhat below the national average over the expansion, reflecting the region's concentration of faster-growing meds and eds jobs. Despite regional variation, overall, the fall in the national unemployment rate has been faster than many economists and policymakers, including some on the FOMC, had anticipated. For example, last September, according to the central tendency of their projections, FOMC participants were projecting that the unemployment rate would be 6.4 to 6.8% in the fourth quarter of this year. But the unemployment rate is already lower than that. Other measures of unemployment or underemployment have also shown improvement over time. These include measures that track people who are working part-time but would prefer a full-time job, and the long-term unemployed, people who have been out of work for more than 6 months. Yet the labor market's journey is not yet complete. More progress needs to be made. My outlook is that as the expansion continues, firms will continue to add to their payrolls, and the unemployment rate will continue to decline. I expect that by the end of next year, the unemployment rate will fall to around 5.5%, which is what I view as the natural rate or longer run rate of unemployment. Unlike labor markets, economic growth needed some snow tires on its journey earlier this year. Real output fell at a slightly more than 2% annual rate in the first quarter. I attribute most of that stall out to temporary factors like the extremely bad winter weather, rather than a sign of weakening in the underlying economy. In fact, during the second quarter, we saw a significant rebound in activity, and I expect real GDP to expand at about a 3% annual pace in the second half of this year and next year. That growth rate is consistent with continued improvement in labor markets, which will help support income growth and keep consumer spending, which accounts for 2/3 of economic output, expanding at a moderate pace. Another positive is the considerable progress that households have made in repairing their balance sheets. But this has taken some time. The Great Recession destroyed a lot of wealth. At the aggregate level, household net worth fell by more than $10 trillion in 2008. It took more than 3 years to make that up. Last year, rising prices of equity, which many families hold in their pension and retirement funds, and rising house values contributed to the increase in household wealth. The improvement in real estate prices means fewer homeowners are holding negative equity in their homes, and delinquencies on mortgages are down significantly. Currently, about 1 in 20 mortgages is seriously delinquent, meaning either 90 days or more past due or in the process of foreclosure. 3 years ago, that ratio was 1 in 12. So things have improved, but there is still a way to go before we return to the levels seen before the housing crisis, when only 1 in 50 mortgages was seriously delinquent. And I do expect to see continued progress in the housing market. We won't go back to the unsustainable levels of construction and surging prices that we saw prior to the crisis, nor should we want to. And like other sectors of the economy, housing won't follow a linear path. In fact, we saw a fairly strong increase in housing activity, including housing starts and sales, in 2012 and in the first half of 2013. Then, as mortgage rates rose in the second half of last year and cold weather set in, that pace of activity slowed down. Looking through the swing caused by the severe weather, single-family housing starts this year have been expanding at about the same pace as last year. The multifamily housing sector has shown more strength, which may represent a longer-run shift from owning to renting in the aftermath of the bursting of the housing bubble and tighter mortgage credit conditions. Overall, my outlook is for the moderate improvement in housing to continue, supported by mortgage rates that are still very low by historical standards and a level of affordability that is better than before the crisis. Similar to households, businesses have also been repairing their balance sheets during the expansion. Corporate profits are at high levels. Nonetheless, business investment has been somewhat slower than one would have expected based on economic fundamentals. We heard from many businesses over the past 2 years that they had the wherewithal to invest, but wanted to wait a while longer until they were more confident that the economic expansion was sustainable and some of the uncertainty about fiscal policy was resolved. We are now seeing that happen. Fiscal policy is less of a drag this year than it has been over the past couple of years, and business confidence has risen. Manufacturing surveys and anecdotal reports indicate that firms are planning to increase capital spending, and we are seeing stronger orders and shipments. Putting all of this together, I expect growth over the next 6 quarters to be somewhat above my estimate of trend growth, which I put at around 2.5%. Of course, there's always a great deal of uncertainty around estimates of trend growth, perhaps even more so today in the aftermath of such a deep recession. I'm a bit more optimistic than some about longer-run growth because while productivity growth has been running low, I think it's good to remember the experience of the 1990s. Back then, over a period of several years, many forecasters revised down trend growth estimates, only to subsequently revise them up significantly in response to strong productivity growth. Turning to inflation, the recent news has been encouraging. Inflation is moving back towards the Fed's goal of 2%, measured by the year-over-year change in the price index for personal consumption expenditures, or PCE inflation. This measure of inflation has increased to 1.6% this year from 1.2% last year. This is encouraging because we wouldn't want to see inflation run either persistently above or persistently below our goal. Consistent with a pickup in economic growth and expectations of inflation remaining well anchored, my forecast is that inflation will move back towards 2% over time. Now, one may ask whether that's a reasonable inflation forecast, given that we haven't seen much acceleration in wages yet. I believe it is. Cleveland Fed analysis, based on several measures of wages and broader compensation, indicates that it's difficult to find a lead-lag relationship between wages and prices. The strongest correlations are contemporaneous ones, especially since the mid-1980s. We should expect wages to rise with prices, not necessarily lead prices. In my view, it would not be prudent for policymakers to simply wait for wages to accelerate before assessing the implications of the stance of monetary policy for future price inflation. Indeed, policymakers must always be forward-looking. We must continue to process incoming information on economic activity, labor market conditions, and prices, and assess whether or not that information is consistent with or has changed our outlook. We also have to keep in mind the risks that surround the forecast, including the geopolitical risks that have escalated in recent weeks. Despite these risks, my read of the data and the incoming information we collect from our business contacts is that the economy is standing on firmer ground than it has been for some time. the economy has made and continues to make substantial progress on its journey back to our dual mandate goals. So that's my travelogue for the economy's journey. But in response to the financial crisis and deep recession, monetary policy took a journey of its own into uncharted waters. The depth and nature of the recession required the Federal Reserve to run an extraordinarily accommodative monetary policy to promote our goals of price stability and maximum employment. The FOMC has kept its policy rate, the federal funds rate, at essentially zero since the end of 2008. To exert downward pressure on long-term interest rates, it has purchased longer-term Treasury securities and agency mortgage-backed securities, expanding the Fed's balance sheet from about $900 billion in 2007 to almost $4.5 trillion today. It has also used forward guidance to communicate the anticipated future path of policy. As the economy journeys back to more normal territory, monetary policy will also need to navigate back to more normal seas, something you probably have heard referred to as policy normalization. Eventually, we will be able to move away from our extraordinary policy tools like asset purchases and back towards implementing monetary policy by targeting short-term interest rates. In fact, already, based on the cumulative progress the economy has made in labor markets, since the start of the year, the FOMC has been scaling back the pace at which it has been buying assets. At our July meeting, the FOMC voted to reduce the pace by another $10 billion to $25 billion a month. If the economy continues on my anticipated trajectory, then I expect the asset purchase program to end this fall. Yet even with the end of the purchase program, the Fed's balance sheet will remain very large, with assets of much longer maturity than usual, and this will complicate the normalization journey. The FOMC has been developing tools to help during the trip. One of these tools, an overnight reverse repurchase agreement facility, is currently being tested. Basically, with reverse repos, the Fed lends securities from its large portfolio in return for liquidity, which is thereby drained from the market. The Fed is also testing the use of term deposits to absorb some of the excess reserves in the banking system. The FOMC has been discussing the design of these tools, which would be intended for limited use during normalization. The Fed's ability to pay interest on excess reserves, with these supplementary tools providing backup if needed, will allow the Fed to move interest rates up to target when it is appropriate to do so, despite the large size of the balance sheet. In addition to taking another step to taper asset purchases, in July, the FOMC maintained its forward guidance on interest rates. This guidance indicated that given our assessment of realized and expected progress towards our dual mandate goal objectives, it will likely be appropriate to maintain the current 0 to 1/4 percentage point range for the federal funds rate for a considerable period after the asset program ends. With the end of the program nearing, I believe it is again time for the committee to reformulate its forward guidance. The forward guidance the FOMC has offered for the path of the policy interest rate has undergone several changes along the way as we've moved from the extraordinary times of financial crisis and deep recession to recovery and expansion. The guidance has tied the eventual lift-off of the funds rate from 0 to a calendar date, to a numerical threshold for the unemployment rate, and more recently, to qualitative information rather than to quantitative measures. While it might seem best to simply give a date about when liftoff is likely to occur, I believe using a calendar date at this point would be poor communication. It could mislead the public into thinking that policy is on a preset course. If the public doesn't understand that policy is dynamic and based on the economic outlook, then a change in the guidance can create its own disruption. Well-formulated forward guidance also has to recognize that economic conditions can evolve differently than anticipated. For example, over the past year, the improvement in the unemployment rate has been faster than the FOMC anticipated just a year ago. My preference is for forward guidance to convey that changes in the stance of policy will be calibrated to the economy's actual progress and anticipated progress toward our dual mandate goals, and to the speed with which that progress is being achieved. This latter piece recognizes the importance of policy to be forward-looking. A faster pace of progress toward our goals would argue for a faster return to normal, while a more subdued pace would argue for a slower return. Forward guidance is just one aspect of the communications that will be an important part of the journey back towards normal monetary policy. The FOMC will need to do its best to communicate the rationale for its policy decisions and to prepare the public for this unprecedented trip. Of course, effective communication is not a trivial task. Yet the potential economic benefits have kept the FOMC striving for increased transparency over time. It's hard to believe that it was just 20 years ago, in 1994, when the FOMC first began to issue a statement after it had made a policy change. Since then, the FOMC has taken other steps, including expediting the release of the minutes of its meetings, publishing economic projections 4 times a year, followed by the chair's press conference, and releasing a statement clarifying our longer-run goals and monetary policy strategy. The FOMC is continuing its journey towards more effective communications. This summer, Chair Yellen asked Governor Fisher to chair, and Governor Powell, President Williams of the San Francisco Fed, and myself to serve on a subcommittee on communications to help the FOMC frame and organize the discussion of a broad range of communications issues. I believe striving for clearer communication will yield benefits, especially as we undertake normalization. As normalization nears and progresses, there is likely to be increased volatility in financial markets. That is not necessarily a bad thing. Indeed, the goal of communication is not to reduce all volatility. Volatility is a necessary part of price discovery in financial markets. But the better we can communicate our monetary policy framework and the basis for policy decisions, the more likely we can avoid undesirable disruptions and turbulence that could result from misunderstandings as we prepare for and progress on the journey to a more normal monetary policy framework and policy stance. In summary, the economy has made considerable progress on its journey back to maximum employment and price stability. Although there are risks surrounding the forecast, including geopolitical ones, my expectation is for the economy to continue to make progress, with growth at about 3% over the second half of this year and next year, the unemployment rate falling to 5.5%, my estimate of the natural rate, by the end of next year, and inflation returning to 2% over the next 2 years. Monetary policy remains extraordinarily accommodative, but as labor markets have shown considerable improvement, the FOMC is tapering the pace at which it is purchasing longer-term securities, and I anticipate that program to end this fall. Given the uncharted waters we are in, the journey back to a normal monetary policy stance and framework for conducting policy is a challenging one, and the FOMC continues to plan for it. The communication surrounding normalization is going to play an important part in how well the journey goes. Explaining the factors that influence the changes in the outlook and FOMC policy decisions, as well as how the FOMC plans to conduct policy, can help the public make informed expectations as the economy evolves and monetary policy travels back to normal. Thank you.
I'm assuming this is the question and answer section now?
I assume we can start.
Well, I just spent 10 years on Wall Street in New York, and these are pretty normal meetings. Thank you for making Pittsburgh your first stop.
Oh, welcome.
My question is surrounding financial imbalances. A colleague of mine at Goldman Sachs wrote a report called The Brave New Business Cycle back in 1997. It described globalization and technology as 2 driving forces behind businesses slowing their employment growth and recoveries, as well as a huge influx of just-in-time inventory that created longer business cycles. The unintended consequence of that, though, was deep financial imbalances that once crested turned into pretty deep recessions. And as they've updated some of that analysis post the Great Recession, I'm curious of your thoughts on potential financial imbalances that are currently being created, and whether you think that there is any risk of avoiding sort of larger recessions when they do occur.
Okay, that's a long question, so I'm going to take it in a couple of parts. First, you're right that we've seen a big technological change. I agree with that. But remember, productivity growth, you're thinking about long-term growth, productivity growth is one of the main drivers of long-term growth. So if you're thinking about the outlook for the economy, one of the reasons I'm actually more positive about longer-term growth is because, right, I expect a technological change is going to lead to productivity growth and therefore higher growth in the long run, which is a good thing for the economy. In terms of the fiscal imbalance or the financial imbalances you're talking about, you know, the Fed is aware, and the FOMC is definitely, you know, looking at that issue because we are in extraordinary times. We're running an extraordinarily accommodative policy, and we are keeping our eye on emerging imbalances, if you will. You know, part of what's going on in the financial regulatory side of things is also sort of in the aftermath of the deep recession and the financial crisis is to try to make sure that we are forward-looking and to be able to identify those imbalances before they happen. So, yes, it is something that we need to be keeping aware of, and the Fed is looking at those, the FOMC and the regulatory side.
Are there any areas that you guys have shared where there are potential greater risk than normal financial imbalances within the different sectors of the economy?
So I think if you go back and look at Chair Yellen's monetary policy report, she had mentioned leverage lending as one area that they were looking at. I mean, I think we're trying to look across things because we understand when you run an interest rate policy at zero for as long as we read, it can lead to the possibility of risk-taking, maturity extension. And so, you know, we're trying to end interest rate risk on balance sheets. So we are aware of some of the, you know, areas where you might expect the interest rate policy to be leading to potential risks, and we're monitoring them very, very carefully.
Great. Thank you very much, President Mester.
Hi, my question is, what do you think it will take to pull the velocity of money out of its deep downward spiral?
Okay, so the recovery is continuing, the expansion is continuing, right? Eventually, right, the Fed is going to, when the time is appropriate, right, normalize its policy, monetary policy, both the framework and the stance. And as that happens, right, then velocity will increase.
Good afternoon. Thanks for being here. I'm Patrick Wallace. I was wondering if you could comment on maintaining a discretionary Fed versus a rules-based Fed as the Taylor rule was proposed.
Right. So it's a good question. I am a supporter of systematic monetary policy as opposed to discretionary monetary policy. But you know, we don't have one rule. So I like to look at the outcomes of various rules because we have various models. We have, you know, various circumstances. Different rules work well in certain models and not well in other models. So I like to look at the outcomes of the rules, right? A whole set of different rules, right, as gauges, but I don't think you can pick one rule and say, I'm going to set policy according to that rule. I think you still have to apply good judgment. But I do want to be systematic and look at the same set of indicators through time and not pick and choose different indicators. So I would say I'm in favor of systematic policy, but not necessarily at this point choosing a particular rule.
I'd like to follow up Stu's question on velocity of money. I'm curious what your thoughts are about how the additional regulations that have been put on the financial system are impacting velocity, and might there be some remedy in the future, because I perceive those regulations as slowing down financial activity.
So I think we all benefit with a more stable financial system. And, you know, I think the Fed and the other financial system regulators have been taking steps to try to improve, right, the stability of the financial system in the future. That said, of course, you know, there is some firms are having to deal with new regulation, and I understand that that's having an impact on their ability, you know, their ability to do it. But in the end, the goal of the regulation and the supervision is to result in a more stable financial system, and that's going to benefit everyone.
Being involved in the financial industry for over 37 years, things seem to be moving pretty well with this normal up and downs until the mark to the market was brought into effect, whatever it was, 7, 8, 10 years ago. And I think it led to an accentuated decline. Do we have any concerns that future regulations would bring back any mark to the market impact to the financial industries?
Well, I don't have concern about that, but there may be other people in the room who do. But, you know, I think the path of the, you know, I think we're moving in a good direction with the regulations. I think we're trying to impose regulations that actually improve the stability of the financial system. And we're working through them, I think, systematically. And we'll see the impact as we go. But I think that, you know, banks are in better shape now than they were. And I think, you know, we'll end up with a more stable financial system, and I think that's a good thing.
One question from over here, if I can. I'm Sue Hill with Federated Investors. We're in Pittsburgh, which of course is the backyard of one of the largest money market fund shops and managers in the world, so you kind of have to expect, you know, something along these lines. Could you comment for me on the, and as you can see, I don't have horns and smoke coming out of my ears either, so you comment for me on the recent shift that seems to have taken place at the FOMC, the discussions around the reverse repo facility, and kind of the downgrade in status that I think we've noted in the last 2 FOMC meetings?
You know, the FOMC has been talking about normalization, you know, talking through the tools. It's an ongoing discussion. And, you know, I think Chair Yale had mentioned that she anticipates that she's going to be able to put out more information on normalization sometime later this year. So, as I said, it's an ongoing discussion. I think the discussions have been very productive ones, and more information to come later in the year.
Two related questions. First of all, the labor force participation rate is near a 40-year low. How much of the decline do you think is structural and how much is cyclical? And then second, Chair Yellen has essentially stated that the unemployment rate currently is understating the amount of slack in the labor market. And do you concur with that?
So, as I said, I anticipate that the unemployment rate is going to fall to about 5.5%. On the end of next year. We're at 6.2%. So I think that gives you a sense of how, you know, close we are. We've seen very good progress, I think, and significant progress in labor market conditions, and I do expect that to continue.
In the labor force participation rate?
Right. So yeah, I mean, so I think there's two, you know, part of it's cyclical, part of it's structural. I think it's difficult for economists to actually parse those things out. But again, I think, you know, as a summary statistic, I still like to look at the unemployment rate. And, you know, I think we do have farther to go, but we're a lot closer than we've been.
And I think we have time for a couple more questions.
Good afternoon. I'm the president and CEO of a community bank in Western Pennsylvania, rural Western Pennsylvania. A lot of our customers are elderly folks who have worked their whole lives. They've saved up $300,000 or $400,000 or $500,000. They have it in the bank, and they were expecting to get 4% or 5% interest, which along with their Social Security would pay the bills or give them some spending money. Obviously, they're not getting that interest, so they're either reaching for yield now or they're cutting into their principal, and they're spending very little. So I would just like someone to be aware that the low interest rate policy, at least in our part of the country, which is part of the Cleveland Fed District, is actually having a depressive effect on economic activity. If these people had their interest income, they would spend it, and then the small businesses would have customers and things would be more active. So it's not really a question, but I just wanted you to be aware of that. Thank you.
Thank you.
I wonder, excuse me, I wonder when the Fed is running its models and doing calculations, are there different regional expectations across the country? In other words, if the Pittsburgh-Cleveland region is projected to grow one direction, is there vast or are there only small differences between, say, Pittsburgh, Philadelphia region, West Coast? And if that's the case, can the Fed do anything to maybe help regions selectively should they find that economic growth is diverging among regions in the country? Thanks.
So we certainly, when we go to FOMC meetings, we represent our district's economy and the information that we're bringing to the meeting. And each president of a Fed brings their information from their districts. And as you know, there are regional differences in the economies of the districts. That said, there's one national monetary policy. So you can't use monetary policy to affect regional economies differentially, right? We basically set a national monetary policy. And that's at the meetings, the discussion is about taking the information we're gathering from our districts and then putting it together to get a mosaic of what's happening in the nation, and then setting a national monetary policy.
All right, well, President Mester, thank you very much. This has been a wonderful presentation. We really appreciate your coming to speak to our groups this afternoon. Thank you.
I really appreciate it. Thank you very much.